Let me start off with a look at just the destruction when it comes to Asian real yields as we see that inflation fear really grip. Take a look at this chart on the Bloomberg, which really does show Asian emerging market inflation-adjusted yields just being really squeezed as we see these concerns over a recession continue to play out, concerns over the entrenchment of inflation as well, and you see those real yields plunging below zero. So you say the fear is that Asian economies will be forced to continue tightening even in the face of a global slowdown.
Yes, I think that's the big risk Asia faces. Now, I mean, let's put Asia within an emerging market context. I think the one good thing for emerging market economies in this particular tightening cycle has been that they have been ahead of the Fed in tightening instead of playing catch up like they have typically done in most cycles. Now, obviously, it's a very heterogeneous entity. There are parts of emerging markets like Latin America and Central Europe, which started tightening a lot earlier. They've kind of kept their eyes on the ball. They've tried to keep sort of rates in pace with how their inflation outlook has happened. For Asia, I think the key thing is that their entire cycle of particularly growth and reopening coming out of the post-pandemic response has been later, more delayed than it was in the rest of the world. Then they got hit with the supply shock, especially the energy price, the commodity price shock this year, and which has landed this region into a bit of an odd spot in terms of having got to the tightening a lot later, not necessarily, I would say, behind the curve because they were responding to their own inflation dynamics, but certainly one where they are now forced with, like you said, real concurrent, at least, policy rates being a lot lower than they are in other parts of emerging markets. And now there is a risk that as they are forced to tighten to bring real rates back up to neutral level, they are doing so potentially over the next few quarters in an environment where the global growth is slowing down and which the region remains terribly sensitive to.
The dominance of King dollar is not very forgiving for Asian FX anyway, right? But where do you see resilience this time around within the emerging market complex in Asia?
So I think the problem at the moment for Asia macro is that in one form or the other, whether it is the negative terms of trade because of the commodity price increases, and by commodities, I mean not just energy, but wider. We are seeing obviously much wider increase in, for example, the food price complex, etc., which Asia is very sensitive to. But on the other hand, growing fears of growth slowdown, potentially even recession in major developed economies a few quarters down the line, are really starting to bear down also on sort of the risk sentiment for a lot of Asia. So relatively few safe spots, if you might, in Asia. I think one thing very interesting now will be after the move which has happened, whether the renminbi starts to be again a little bit more range bound than sort of how negative it has been so far. A lot, of course, depends. It feels like the Chinese economy is definitely bottomed out. What's not clear is how quickly it is rebounding from here, one, and two, what is the risk with respect to, again, repeated sort of lockdowns. But it does feel like if those don't play out adversely for the economy, then maybe the currency can become a little bit more resilient.
We are hearing more concerns when it comes to China's debt level. Again, of course, they tried to really rein in leverage back in 2017. They had to go completely the opposite direction. And we're talking about emerging market investors really putting so much hope in this stimulus to come from Beijing. This chart on the Bloomberg showing that debt levels are incredible in China already as compared to their GDP. How much risk does this bring to the economy?
So I think you can see this now in sort of financial markets and the way assets are responding in China, that in spite of what has been actually a fairly large number of incremental steps taken by policymakers in China to boost growth, the market response has been a lot more guarded, and which largely talks to this concern that whether China can afford to really take a big bang approach, which kind of raises the leverage levels again after not having been able to brought down over the last few years. So yes, I think China is limited in terms of the quality of that response, as in it can't afford to get the balance sheet debt levels start rising up again. But there are several points in their toolkit which can help them sort of bring a flow to the market and to the economic trajectory and be able to sort of revive it from there.
What political and geopolitical developments will you be watching for the rest of the year for China that could have big economic implications?
So So I think geopolitics matters for the region more generally. I think the two very critical points are, of course, what is the trajectory on what's happening with the Russia-Ukraine conflict, and that is because it impacts via energy prices, China and the rest of this region, very importantly. China, of course, is having its own, it's a big year of political developments in China, and so to that extent, the noise around that would be fairly critical to watch as well. And a third angle, of course, is around, which is also related to the first 2 points, is about the relationship between US and China on its trade aspects, which has largely been going sideways with sort of some positive and some kind of negative news, but something to be clearly looking out for over the next few quarters.